Manulife Financial released their debt survey this week that indicated that 1 in 4 Canadians are going to have to sell their home if interest rates continue to go up, and that 18% are already feeling the pressure of higher interest rates and feeling the squeeze of a tighter economy. And in today's video, we're going to discuss Manulife's debt survey and also discuss what you can do to make sure that you aren't one of those 4 people that has to sell your home. The definitive guide on how to manage your credit, product, penalty, price in that order. It's never been more important to get your mortgage right. All right, so welcome back. Manulife this week released their annual debt survey that they've been doing for 11 years, where they survey 2,000 Canadians, 2001 to be exact. And they come up with several different indicators with respect to debt. And this year's is especially astonishing, considering that 1 in 4 people are considering that they would have to sell their house if interest rates continue to rise, and 18% of people are already feeling the pinch of higher home prices. But before we get into all the details, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers giveaway. We're giving away $5,000 on July 1st. In order to enter that giveaway, subscribe to this channel and go to 360giveaway.ca and fill out the entry form. By the way, you get an extra entry if you follow me on Instagram or if you share the contest socially. Okay, so let's get into it. Let's show you the news articles today. Nearly 1 in 4 homeowners would have to sell if interest rates rise more, survey finds. So this was a survey that was done by Ipsos on behalf of Manulife Bank. They surveyed 2,000 Canadians between the dates of April 14th and April 19th. So this is going back almost 2 months with respect to the data that's here. Now they've held on to this for a couple of months. It would be interesting to see where we were at today if you did the exact same survey, because I have a feeling that some of the numbers would go up with respect to people's anxiety around the economy. And I want to jump in and show you right away here. This is the survey and these are the results. So first and foremost, Canadians are seeing rising costs. 1 in 5 homeowners believe they can no longer afford the house that they own. This makes a lot of sense, considering that a lot of people bought properties in the last year without really thinking about it, just kind of going in and bidding super high numbers for properties, not thinking about the overall costs that would come along with that mortgage when they bid $100,000 or $200,000 or $300,000 over list. Now, what's interesting is that people are concerned about a 1% or a 2% interest rate hike. However, they weren't concerned about bidding $100,000 over the asking price a year ago, which led to typically about $450 more in costs. And we said quite frequently last year that if you were getting into bidding wars and you are buying a house, unless you absolutely have to, you probably shouldn't be participating in the market. And lo and behold, here we are, interest rates are going up and housing prices are starting to come down in some areas, and the heat that was in the market has settled down. We said that this would happen 3 to 6 months down the road, and here we are, it did happen. Now, Canadians are 5 times more likely to report that their spending is outpacing their income. That is also no surprise. There is going to be a need for budgeting here in the near future for most Canadians. 50% admit to reconsidering their summer vacation plans due to affordability concerns. Now, that's probably a good thing. If you are having budget concerns, reconsidering that summer vacation or that winter vacation for that matter is probably one of the first things you can do to save $2,000 or $3,000 or $4,000. And that is very prudent in this kind of economy. Now, 71% of Canadians who don't own a home worry about saving to buy one. Yes, we see this. We have a down payment challenge that's linked in the description below that helps teach you how to collect your down payment faster. But yeah, I believe that a lot of Canadians are very much concerned about being able to purchase a property, especially when you consider that about a third of Canadians are renters. And those renters are seeing that gap between where they're at and the cost of housing extend pretty much on a daily basis. At least they have been over the last 2 years. Now, 4 out of 5 Canadians think there's an affordability crisis in Canada. There is no doubt about this. When you look at the price of real estate relative to incomes in Canada compared to somewhere like the US, yes, that Toronto and that Vancouver market weigh on this factor in the economy quite extensively. And if you are in one of those 2 really expensive markets, absolutely there is an affordability crisis. Now, there are markets in Canada that don't have an affordability crisis. Think Calgary, think Edmonton, think Saskatchewan, think Manitoba. There are lots of markets where you can still buy a reasonable home for a reasonable price with an average income. Now, 84% expect interest rates and inflation to continue to increase over the next 12 months. Yes, the inflation is likely something that is going to be here at least until 2023. Interest rates, on the other hand, could be an interesting topic of conversation because it is very much clear right now that the US economy is in a recession. In July, at some point, they're probably going to announce that they've had 2 straight quarters of negative GDP growth, which is officially a recession, and that they're quite frankly in that situation right now. And quite frankly, so is Canada, which means things are going to get really, really interesting for a 6 to 12 month period. And at some point, we are going to see an end to those interest rate increases. Now, 25% of homeowners believe that they overpaid for their home, considering that 25% of homeowners bought in the last 2 years. They're absolutely right with respect to the fact that they probably overpaid for their homes. But here's the reality of this conversation, and here's what you need to think about. Whether you believe you overpaid for your house or not, the question shouldn't be, is now the right time to buy, or did I buy at the right time in the market? Because that question is really a short-term question. And if you are a real estate investor who's going to flip a house, or you only plan on living in a house for 1 or 2 years, then yes, you should be immediately concerned about the market. However, if you're buying a house to live in and you're going to live in it for the foreseeable future, you probably shouldn't worry as much about the fluctuations in the market. Because if you're constantly worried about the fluctuations in the market and you're thinking, hey, I'm going to wait to buy, or I'm going to wait to sell, or maybe I didn't buy at the right time, you're going to spend a lot of time thinking about real estate when you shouldn't. And at the end of the day, if you buy a house to live in for the long term and it's affordable for you, so you've got the right mortgage, you've got the right financial setup, and you've got a plan, well, 5, 10, 15 years down the road, it doesn't really matter whether you bought at the top of the market or the bottom of the market. What matters is that you bought the right home for you and your family for the long term. And if you really think about it from a long-term perspective, just buying the right home and making sure you're in the home that suits you the best and meets all of your family needs, well, you can probably give up a lot of the stress that you're going to spend thinking about the market. And that's it. If you're in a 5 to 10 year plan here, then you don't have to worry about the market cycles, because whether you bought at the top or the bottom, 5 to 10 years from now, you're probably going to be better off. But again, if you're investing, I wouldn't say this is a good time to be investing in real estate in Canada, regardless of what real estate investment networks are telling you, or real estate groups are telling you, or so on and so forth. It's probably not the best time to do it, because we are going to see some declines and some volatility in the market. That just goes along with those higher interest rates. Now, one last thing that I want to show you here, and this is the big one. 73% of Canadians don't have a written financial plan, and 47% don't have a household budget. These are the 2 things that you can do right now to help yourself financially, is create a written plan and create a written budget. And I'm not a big believer in going through your budget every single month. In fact, we have a 20-minute budget that's linked in the description below, where we basically just once or twice a year do a reset for a month. We look at what we spent last month, and then we try to drill down and eliminate some of our spending for the next few months in order to do basically a financial reset. But if you don't know what your monthly costs are with respect to your mortgage, with your respect to your vehicle and your insurance, and all the things that are your fixed costs. So if you don't know your fixed costs every single month, then you need to do that right now. You need to figure out what your costs are every single month that you cannot avoid. And then from there, you know how much money's left at the end of the paycheck, and things like food, things like dining out, things like entertaining, things that are variable costs become things that you can then easily budget for. So if you want to set up yourself up for an easy budget, just figure out what your fixed costs are, what the things you cannot avoid every single month are, deduct that from the amount of money that you take home every single month, and then you know what your money is that you have to spend on things that are not necessarily necessary, but things that are wants rather than needs. And it's really that simple. A budget, a written financial plan can be that simple. I make this much money, my fixed costs are this, and this is how much I've got left. And then you spread that over the 30 days and make sure that you aren't overspending on a monthly basis. And a big piece of that is making sure that you're taking a big chunk out and putting it aside, making sure, whether you call it paying yourself first or taking profit first, or just keeping some of your money every single month. Because that's the big game here, is we're trying to keep as much money as possible. Well, doing that is a hugely important piece of the puzzle. Now, we're going to put a bunch more videos together on financial planning, on things like this in the coming future, how to deal with inflation, how to deal with higher costs. Stay tuned for that. Check out some of the other videos on the channel. And again, if you found this video useful, do me that favor, hit that subscribe button and that notification bell and that like button. And don't forget about that 25,000 subscriber giveaway. We'll see you on the very next one. Cheers.